exploits in the crisis, and during the boom, is not reduced as it increased during the crisis. Okay, and the problem is that the banking activity is very cyclical, and you need to take into account that the cyclicality of banking business is bad for the economy, because if the banks are getting worse with the macroeconomic wave, they are less able to give credit to the economy in the worst moment, when the economy needs more credit in order to impulse the economy. You know what I mean? So the cyclicality of the banking business is a problem for the world.
These three parameters, two questions. They're estimations, so
you need to estimate. Yeah, of course.
And they're fixed for every bank, or each bank has its own probability of default dependence?
You need to, for example, today was approved the credit risk parameters, the models of Abanca. The European Central Bank approved the models. It should be approved by the supervisors, but you need to estimate these parameters by portfolio, because if that, you, as a bank is a huge entity. A bank does not have only one parameter for all the portfolios. You need to have the PD of the retail mortgages, for example, in Madrid, in region of Madrid, or in Basque Country, or in Spain, if you are a multinational bank. The LGD of this of the portfolio of retail mortgages, what does it mean LGD? Loss given default. How much I'm going to lose if the borrower is in default? What is this? Imagine you have a retail mortgage. The loss given default is lower because you have the guarantee of the asset. You have the guarantee. It's true that the bank needs to execute in the court this guarantee in order to reduce the amount that is still in arrears from the borrower. You know what I mean? But this is LGD is much lower for retail mortgages because you have a guarantee. If something happens, the borrower, the bank is going to execute the guarantee, and then the loss is going to be reduced because you have the guarantee, the flat or the home of the borrower. You know what I mean? One thing that is important. In Spain, we are a country that protects the creditor, and you can do analysis, critical analysis about this. More than other countries. For example, in Italy, if you are a borrower, you are in default. Imagine that your home, the value of your home, market value, is 60, but your exposure at default, your debt, is 80. The bank can execute the guarantee, and then the borrower does not have to pay more. It's settled. The debt is settled. In Spain, no. In Spain, still, you need to pay 20, additional 20. You lose your flat, but still, you need to pay 20. This 20, for sure, are going to be sold to investment funds. I will explain you later on how it works. Through a special purpose vehicle, you can manage a portfolio of non-performing loans. Non-performing loans are those that are in default. Non-performing loans you need to sell to investment funds. I will explain later on because of the impact of regulatory capital and the impact of provisions in banks. They are forced to sell these non-performing loans. These parameters, what is interesting is that you need to estimate by portfolios, by regions, by geographies, etc., etc. You can have a look of the LGD parameter in this database that is very good, that is there is a newspaper every month and it's free. It's credit data dot, I think, credit data, is credit data or something like that. I don't remember the name of this database. Let me check it. You can.
Profe, what was LLP? Non-loss probability.
Non-loss provision. No worries, I will explain later on. Global credit data, this one. Okay? Here in this database, you have a lot of information about the parameters by regions. It's interesting. Usually the LGD that is used is 40% for this parameter, but you need to calibrate. I will explain that for solvency purposes, the parameter that you are going to use is different. For sure, if you want to work in a bank, in internal rating-based models, or in a consultant firm, they need people to develop models, okay? And this model of PD contains not only the current economic situation, also the macroeconomic expectations. You can use consensus forecast. Always the forward-looking information is much more important than the current one or the past or the historical one in order to develop the models. And also other specific variables of the borrower and also of the region that where the borrower develops their activity. Okay? So PD is also cultural. Oh, why? You need to estimate the PD in different regions. For example, in Latin America, if the people learn how to negotiate with the bank, the PD in the crisis increases more than is reduced during the booms, because people learn how to be in default, and if they can extract and they can recover the asset, making a negotiation with the bank is very dangerous. That's the reason that the banks that do not have incentives to give you, to negotiate with you. They prefer to sell to an investment fund, and the investment fund, you can negotiate with him, or other people would be interested in executing the guarantee with the investment fund. So PD is also influenced by commercial law. Imagine that I am Italian, and the market value of the guarantee is 60, and I have a debt of 80. I have incentives to be in default. You know what I mean? So the regulation gives me incentives to be in default because I can settle the debt, in this case, because of the market value of my guarantee is lower than the debt. So I am with negative book, negative equity. I have negative equity, and then I have incentives here in Spain. You don't have this incentive, okay? Because
What do you mean by default? Bankruptcy?
no, by default is that you don't pay the last 3 bills, non-performing loans. Bankruptcy is, in Spain and in other countries, you can have a personal bankruptcy, and bankruptcy from the firm, Chapter 11 in the US. Okay? Here in Spain it's called ley concursal, concurso de acreedores. But bankruptcy is liquidation, that the solution of this ley concursal or Chapter 11 is the liquidation of the firm, to sell the assets in order to pay the creditors. Okay? Usually in these cases there is nothing for the equity, for the shareholders. Okay?
So for banks, is any regulation that says you can only give mortgages to certain profile of clients, or that's up to the bank internal risk team?
Okay, good question. The banks have their own internal models, their internal people in the risk department, that they assess the credit risk of people. But also, if they develop algorithms, the supervisor can supervise you whether these algorithms have some bias to specific ethnicities of people or locations, etc. The supervisor have this ability. In fact, if you go to the Federal Reserve, you will see some fines for banks for the way that they give credit to the economy. But usually, if your model is perfect, is objective, and you develop without any bias, bias doesn't mean that from economic reason I think that you are going to be in default and I'm not going to grant you the loan, of course, okay? And if you are fine, you need to make some social activity for your region. Yeah? If you are fine, also from time to time the Federal Reserve obliges the CEO or the president to do this social activity. This is not possible in Spain, it's not the usual case. But I think it's they have their own supervisor of internal models, like you can be in the future one, because in the European Central Bank, in the Federal Reserve, are people that have a good knowledge of econometrics, and then they can develop this. In fact, my first degree was in statistics, my second degree was business administration, and what I love is that accounting is not that what the people think about accounting sometimes, from time to time. Accounting is much more than the people can think. For example, who are the owners, who are the shareholders of the group, how you can look for networks of ownership between different countries, different investors, different anti-money laundering. When you are doing anti-money laundering, you are following the money through some countries that are more opaque in order to that they don't publish in the trade register the financial statements of the firm, and you need to follow this. So accounting is not only the first or the second year of the undergraduate. Okay, close the laptop if it's possible. Sorry. Close the laptop.
Okay.
Okay. Because I prefer. I'm going to give you all the slides. Okay.
Okay.
So here you can see that the incur loss model before before IFRS number 9, the accounting standard, you recognize loan loss provision in this way. But what they do is a backward-looking approach, estimating the model in 2018, simulating that they apply the model here. And this is the expected loss estimated through the model that they developed in 2018. It's a trick because in reality you don't have the data here, okay? And this is very simple because the reality is that you estimate the model in a world that is perfect, you can estimate the losses, and then this is very simple because in this case you are simulating in a perfect model that the model is going to estimate perfectly the future losses, but this is not the reality. But given that you are using data from these years, this would be the ideal situation where the losses does not depend on the macroeconomic cycle. And then you are going to be able to give credit to the economy in the same way in the crisis and in the boom. But this is not real because in the end, every year that you recalibrate the model, this is going to change a little bit. Every year that you fit the model, you are going to fit the model every year. After having the new data, you fit the model. And the beta is going to change a little bit, in my experience. Okay, do you know what I mean? Do you follow me? So the betas of the associated to the model are going to change, and then this is not realistic, but it's good to explain that what we try to do is that you are less sensitive to the macroeconomic cycle. And then this is good and generates a positive externality because you are going to be able to grant loans to the economy in a better way because you are not sensitive to the business cycle. Do you know what I mean? Yeah?
Some questions. For that example that you said, negative book value, so this is actually from immigrants in Spain, because at least in Peru, when you have a mortgage, they will never lend you the value of the actual house. They will make you give 30% and then do another haircut and then give you like 50-60% to be safe. So when they can actually, when you go default, because in Peru they have a high risk default, they will just grab it and cover it the whole thing. Even like they will have someone to actually like price the house, and they will usually price it lower than it actually is, so they can keep the house and don't give you anything. Like let's say you owe 50 and the house is 60, they will say it's worth 40, so they take the house and make you pay. So how does it work here?
The problem is that you are the starting point of the transaction, okay? This is what is called loan to value. Loan to value should be lower than 80%. What does it mean? That the loan that I'm going to grant, maximum, should be 80% of the market value of the guarantee. This is, but in the financial crisis, in 2008, 2010, you had some banks in the US, in Europe, that give you 120% because for the furniture, for whatever, very flexible credit standards, so I'm going to give you why you don't want more, and the people incentivize, no? Get more because you need to pay the furniture to purchase something for the home, etc. But right now it's 80%. But imagine that you purchase, in a cycle in the economy, you purchase the flat here, and then it's 80%. But if you are going to experience problems when the macroeconomy is getting worse and you are unemployed. Perhaps it's here. Perhaps the loan to value there is 110% because the market value of the guarantee is going to fluctuate. It's going to be very sensitive with the macroeconomic situation, and then does not fluctuate. It's fixed. It's the loan that you have. You know what I mean? And then if you are here, the bank has a problem, and also you have a problem. It's more problematic for the bank, the situation in Italy or UK, than in Spain, that still you need to pay more, okay? So that's the case. You are perfectly right at the beginning of the transaction. It's not going to be the case. Specifically, right now the credit standards are less flexible, are much more much stricter than before. Right now you cannot get a loan of more than with a loan value larger than 80%. But imagine that it's 75% or 80 the maximum, and then the macroeconomy is getting worse. So you need to take into account. So we need to calibrate these parameters. This is not calibrated because it's the real one. These parameters for portfolios, for specific. Next week, you will do some exercises, real exercises that I uploaded in the Aladdin platform related to these parameters. We are not going to develop the models, but if you go to, it would be interesting for the next week. I'm going to ask you two things. When I show you how to extract data from Orbis or from other firms, I'm going to ask you something for developing your professional judgment about one banking system that I'm going to tell you later on. And the other thing, it could be interesting to download the financial statements of a bank from the web page of a bank and to read something about IFRS number 9, okay? But I will explain later on. So this is for mortgages. And you can see the expected losses are lower. Why? Because the last thing that you are going to be in default is your home. Retail mortgages, usually the credit losses associated to retail mortgages are lower than, for example, this is when you have the model, you have the PD for every year, the LGD, and you can estimate the expected loss model. That is nothing. Okay? I uploaded this Excel file. But this is different to consumer finance. Imagine that you are purchasing something for your home or also for automobile, for cars. For cars, the expected loss related to cars, if something happens with the car and the macroeconomy is getting worse, I don't mind. You know what I mean? So the expected loss of those loans are much more different than the retail mortgages because you have these different incentives to be in default. Then the parameters are pretty different. You cannot use a parameter of mortgages in comparison with the consumer loans or for car loans, etc., etc. You need to take into account. Also for student loans, you have a lot of loans for student loans in the US. In Spain, it's not very usual. There is some development, but still is very scarce. In the US, there are banks that are specialized to provide student loans, okay? And at the end of the degree, you have a debt with the bank, okay? And you need to pay back when you finish your degree, okay? So what is important for me is to show you that in the crisis, in Kurlo's model that we applied before, we recognize the problem when we have the problem, and we try to change to an expected loss model. For example, this is very simple. Imagine that right now the economy is getting worse. Not the current you look at the fourth quarter of 2025, is okay. But imagine that consensus economics, the expectations, as UBS says about our capital markets, is going to be not as successful as 2025. Imagine that you go to consensus forecast and say, the vast majority of financial analysts say that it's going to let it worse the macroeconomy in the following 2 quarters. You know this. And you know this, that if you trust with this estimate, that the unemployment is going to increase. Unemployment is the most important variable to predict credit losses. So imagine that we are at the end of the first quarter and the macroeconomy is getting worse. The GDP is negative, minus 0.1%. The expectations from Bank of Spain Financial Stability Review is telling you that really we are going to have more quarters in a worse situation than the current one. The unemployment is going to increase, and we know in a portfolio of borrowers that statistically 2% or 3% are going to be in default in 9 months or 8 months. What need to do in accounting to take into account this simulation in order to anticipate these losses? You know what I mean? And then it disciplines the bank in order to take actions from the managers. Okay? And this is what the Bushman and Williams 2012, 2015, the research has shown. That is very important to discipline the managers anticipating the bad news. If you delay the bad news, the bank is not going to discipline until they have a serious problem. And given that the crises are non-linear, specifically in this parameter is non-linear, it increased much more in the worst macroeconomic situation than is reduced in the good, in the boom. So this is the losses increases a lot, and then when the losses increase, you are not obtaining enough interest for the borrowers because they are not paying the interest. So you have less income and higher expense in the profit and loss of the bank. You are suffering a lot. Okay, this is not the case right now. In fact, I will explain that after the invasion of Russia in Ukraine, the interest rates increases, and this was good for banks because those banks that are retail banks, as we are now going to see, they had a very good situation because the net interest margin increases, specifically for those that are focused on retail. Or Spanish banks, Santander, BBVA, Banquita, etc., are retail. We don't have Spanish investment banks, are very small. Santander and BBVA tries to do something about this, but still is not important, so important to profit and loss account, although they have improved a lot. I will show you later on. So every portfolio should have their own credit risk parameters. And the credit risk is the most important risk in a bank. In a retail bank, I'm not saying in an investment bank. I will show you how an investment bank works. Okay, so questions?
Yeah, like how do the lenders like protect themselves from like local laws, like Spanish laws, law of like second opportunity, from like giving out more credit to like SNF people?
Yeah, you have. This is a good question. In fact, this second opportunity in a cost-benefit analysis increases the loss given default for banks, and then when this was impounded in the law, the parameters should be recalibrated with the new situation because in the end it's a transfer of wealth. I am transferring wealth from the borrowers, from the banks to the borrowers. I'm giving the second opportunity who is going to suffer this cost, the banks. You know what I mean? So in the end, you are transferring wealth in the economy, protecting this second opportunity for people is a very good question, and then it's going to affect the parameters. So the parameters are very specific, not only for state law, also for regional laws. If you have some region that is protecting less, or some court cases, we estimate some courts. For example, in Italy, the regions are very different, and there were some judges interpreting most dramatically the law than others, and this affects also my historical PD, my historical LGD, because it's changing the incentives to be in default. You know what I mean? Specifically in firms, because firms, the liability that you can have in a firm is maximum, is protected by the amount that you invested. Unless you make a fraud, and the judge can deliver responsibility to your person or to your family or to your whatever. You know what I mean? And that's important. This should be taken into account when you are estimating the volume. Of course, they take into account these things. Okay? Okay? Right now the PD is I thought that the 2025 was going to increase more than it is the case that the people in banks tell me. But I thought, my impression is in the following months it's going to increase a little bit. Not in a dramatic way, but it depends on the expectations, macroeconomic expectations, okay? And with this new geopolitical situation, I don't know what is going to happen. You know what I mean? Okay. So, ask anything that you want to know,
So I have a question.
Okay. Only one?
Yeah, one practical question. So it's like, for instance, when you work, I have a model and then I send my financial rate, the interest rate provisions to accounting so they can put in the financial statements. It kind of works the same way. Like you have the model and then you update the provisions yearly.
Well, interest rate risk is not covered by loan loss provision. Directly. Indirectly, you have to manage the interest rate risk, taking into account the maturity of the assets and liabilities. I'm going to explain you later on with the financial statements of a bank. Okay, the maturity is very important. But indirectly, you are right that if you increase the interest rates, what is going to happen? My net interest margin is going to increase as a bank, but also the PP is going to increase. Why? Because there will be some borrowers that could have experienced some default because the interest has increased and they need to pay larger bill. For those borrowers that are exposed to variable interest rate. If you have a contract with variable interest rate, for example, in Spain, before last financial crisis in 2008, more than 90% of the contracts were variable interest rate. It came the crisis, European debt crisis, that was horrible in the first semester of 2012. It was horrible. I was involved in at the National Court related to the Banca case because it was recapitalized with 25 billion of Spain, and then there was a huge court case about this. At that moment, Bankia was the most important bank that with the highest sensitivity to interest rate risks. But it was composed by 7 saving banks that didn't have any other opportunity to get the mobile. They don't have any opportunity to get income from other activities. It was not the case of CaixaBank. CaixaBank was diversifying the source of income, and Juan Alcaraz did a very good job diversifying the source of income in this saving bank. But Bankia, Bancaja, that was part, Caja Insular, Caixa Laietana, Caja de Ávila, etc., that was part of this, were the most important retail mortgages portfolio in Spain. And when you have retail mortgages and the unique source of income is interest rate, if the interest rate decreases after the crisis, you have a problem. No? Do you know what I mean? What it means? What happens that during the periods in 2016 in March, we have negative interest rate, negative Euribor. It was crazy. We didn't explain anything in the school before in the universities about negative interest rates because we thought that this was impossible, but was possible. Imagine a saving bank or a bank that is very sensitive to interest rate. They started to sell, in order to recompose the profit and loss account of the bank, they started to sell contracts as a fixed interest rates. and they provide you a very good offer of fixed interest rates at 1%, that right now you can think that is crazy, but at that moment the Euribor was at minus 0.50, so the spread was 1.50 for them. But this 1% right now is not competitive. You have a contract that is reporting losses in terms of market value for the bank, but at that moment provides income to compensate those contracts that you have at variable interest rates and you didn't obtain anything. Do you know what I mean? Then was the perfect moment to finance a real estate asset, etc., in order to recover the value the real estate assets at that moment. Okay? You know what I mean? Right now, the banks in Spain, the portfolio of loans is almost 50% fixed, 50% variable. So we changed the culture. It was difficult, right? It was difficult. But we changed the culture of people, and right now, a lot of people, we have very competitive mortgage loans in Spain. It's because of the protection to creditors. It's not because of the efficiency of the economy, it's because we protect the creditors in Spain. And that's reduce the pricing. And that's reduce the PD, and that's reduce specifically the LGD. Okay? And you need to know the origin of this. Okay, so more things. You can see that the credit cards also, the expected losses, but these expected losses are lower than consumer finance. Why? Why is lower? It's very simple, the reason.
Because there's no asset?
Because?
There's no asset?
No. Well, there is no asset, it's true. But the loss is very, if there is no asset, the loss should be larger, no? Right? But the loss is not too high. Why? Because they are, every month they make the loan rollover. If you don't pay this month, they are not going to give credit. So then you can reduce the loss. Because if you don't pay this month, forget it. Next month you are in default, and the bank is not going to provide more credit. Okay, any question? Automobiles, cars, you can see that the expected loss is larger. Of course, the expected losses also depend to the economy. This is in the crisis. We didn't have data about SMEs and developers in order to develop the models. And you can see that the credit cards in Mexico, the expected loss is much larger because PDs are larger in Mexico, and then you need to estimate the credit risk parameters by portfolios, by regions, etc., etc. So you need to know that every person or every firm that is in the portfolio is similar to others that are in the portfolio. You cannot mix firms that are, for example, portfolios by sectors, okay? Because if a sector suffers a shock, you have the shock in your credit risk parameter. But if you diversify, that's not mean anything. You need to take into account that you need to anticipate the losses of the sector, the losses of the region, the losses of the sector. And this is very important because you discipline the bank, and then the bank is going to take actions before the losses are going to happen. You know what I mean?
Well, also taking into account, I think like in Mexico and the US it's the same. Like every 7 years, you have a debt like default, like it erases from the system.
Sorry, could you repeat?
Like in the US and in Mexico, when you have like you default on a loan, then you have it in default for like 7 years, it no longer appears in the.
It depends on the states. There are some states that you have maximum 7 years and you have a new opportunity. In Spain, there is no threshold of 7 years. You can apply for the second opportunity law, and a judge can decide whether you are able to be in default without any other.
So,
but you need to justify very well. You need to make a report. Your lawyer should be very good in terms of how you justify that you were in default because of your investment in the firms, etc. And you need to provide a lot of information. Okay? This is not This is not, yeah, and in fact, you remember one thing that is important, in the US, in some states, you cannot execute the home nor the car, those assets that are minimal for the people. Here you can execute everything. And it comes from our history, yeah? The history, from time to time, I don't know if you know I was in a talk on Tuesday about Juan Sebastian Elcano, I don't know, the first sale of that went to Philippines and to America, and the person who was explaining us the life of Juan Sebastian Elcano explained that from time to time they obtained the funds and invested in these trips from their own family, and they were embarrassed because at the end he died in I don't know, in the last trip was going to Africa or to Asia, and when you were in Banrasi in 15th century, 14th, 16th century in Spain, you went to jail. Juan Sebastian Elcano died, but imagine directly, because of you were not able to pay back the loan. Also, in Catholic, you know that the trade unions or cooperative were an idea of the Catholic Church in order to promote social benefits for people, to give access of credit to people that are poorer, etc., etc. When you didn't pay in 13th, 14th, 15th century, you can be, I don't know how it's called in English, excomulgado. And for example, the oldest bank in Europe is, I think it's Monte Siena, is an Italian bank that have the, I don't know how to tell you this in English, because it's a bulla papal, that if you are in default, they can forgive this default. You know what I mean? So it was, but in the end, was a disciplining factor to borrowers when they are asking for credit. You know what I mean? In the end, you need to discipline the society in order to invest the resources of the society in the best projects. Okay? And that's important. It's what the banks do. The banks are the best partner that you can have in your business. Because if you pay a low interest rate, they are not going to create any conflict. Your shareholders, your partners can create problems with you. Okay? But the banks, remember, that are the best partner that you can have. Because if you pay, they don't mind. Okay, what you are doing. You are paying, you are not in default, so they are not going to create, and they allow you to generate business, they are very happy if you are reporting profits, if you are distributing dividends, etc., etc. They are not going to be jealous about this. But other partners could behave in a different way.
So, following on that question, so in the state you get tax write-offs, right, or those losses. In Spain it works the same way.
Yeah. Write-off is when you for example, it's not necessary that one question that is important. Write-off is when you delete this asset from the balance sheet. Okay. Imagine that I provide you a loan, your name was Alex. I provide a loan to Alex, and Alex is in default. I cannot recover anything, but I think that I'm not going to recover. The value of the loan I put, Alex exposure at default is 80, and I put a loan loss provision of 80. So the accounting value is 0, okay? And I decide to write off. To write off is the drop from the balance sheet, okay? I'm going to eliminate from the balance sheet, okay? Is one thing that is confusing for the people, I have still the right to recover the money. I will try to execute the necessary steps to recover my money. But in accounting, the value is 0, but still the bank is going, and the bank can sell these assets to an investment fund. And if the investment fund paid 10 for this asset, although the accounting value is 0, the bank is going to report a gain of 10, and the investment fund is going to ask for 80. Huh? But the investment fund usually invests in mortgage loans, paying a discount of 80% of the nominal value of the loan, and the bank is going to fight in court cases during 7 years, 8 years in order to receive the guarantee and to make the spread between the market value and the price they pay. I will explain later on how it works.
Is it the same if it's sold to an investment firm to then like a debt collector?
Yeah, it's the same. But usually an investment fund is more focused on loans that have guarantees, and debt collector is these guys that are going to pay almost less. Almost nothing, but they are going to try to recover. And they,
Call you.
20%.
absolutely. So, okay. So this is Vancouver. So this is, for example, the models in BBVA. You can see in Pillar 3 disclosure. Pillar 3 disclosure is the disclosure of this credit risk parameter that is in a different document to financial statements, where they explain more about it. They explain a lot of the technicalities of the internal model. It would be good if you can have a look at Pillar 3 of BBVA or Santander or whatever, or Bank of America or whatever. You have a lot of information about portfolios, the credit risk parameters, etc. The value at risk, you analyze here in Master Economics and Finance, value at risk 90%, 95% or 99%, etc. These are the PDs weighted by exposure and default in different portfolios. You can see that the retail is much larger than the others. And you can see here some numbers that you can have a look. In the Pillar 3 disclosure, they explain you the models that have been authorized by the supervisors, that have been approved by the supervisor. You know what I mean? They are going to, and for example, this is for the BBVA group. Of course, you know the difference between the separate financial statements and consolidated financial statements? Consolidated is for the whole group, and individual for the separate, for example, in BBVA you have Bancomer in Mexico, you have BBVA in Spain, BBVA Colombia, in Colombia, BBVA Continental in Peru, etc. And they have to develop their own models. What happens? That in some countries they don't allow to develop internal models still. For example, I think in Peru, and you have some models here that you can apply individual level, but also the supervisor that needs to approve your models for the consolidated financial statements is the ECB. If your headquarters are located in Spain, so the supervisor is the ECB, okay? And they need to review with the problem that in some countries, still the central bank don't allow to develop internal models. In US, they develop internal models for internal purposes, but they don't follow internal models for solvency purposes. There are two worlds that are different, solvency and accounting. I will explain later on. Both, you have different models for accounting purposes and different models for solvency purposes in the lab. I will explain later on. Of course, there is an equivalence between the PD and the credit rating. What does the credit rating what does the credit rating do? They analyze your ability to pay back the debt, long-term debt or short-term debt. They attribute you a rating, a credit rating, based on your ability to pay back. So the same, should be consistent with your PD. In fact, if you go to the financial statements of a bank, you will see the equivalence of the bank. At the beginning of the expected credit loss model, the banks didn't want to report which is the equivalence between the PDs, the non-PDs, and the rating, because if you show 1 year, the supervisor knows, and the following year you cannot change, okay? You cannot change. But this is for, I think, a Standard Chartered. I extracted in the first year of the Standard Chartered is a liquidity bank. In the first year, I extracted from the financial statements, and I always show this could be different by bank, but you need to be consistent, time consistent. You cannot change the equivalence between PD and ratings year by year. What is interesting for them is that if you granted a loan to Telefonica, and Telefonica, imagine it's BBB, I don't remember it, whether BBB or BB, and you have this equivalence, given that they have this credit rating here, the supervisor is going to look at the credit rating, at your PD, and is going to compute the provision for Telefonica, and I say. And if it's not consistent, you need to justify why it's not consistent. Perhaps it's not consistent because my PD is lower because I have a guarantee, special guarantee. Because I have a specific guarantee over a specific assets, and then the PD is lower and the LGD is lower because of I have a special contract to this company, because I have a special guarantee. What is called pignorados. You have some pignorados assets from the balance sheet, so guaranteed assets, some covered assets that are covered is contractually some specific losses. Okay, this is what covered bonds. I don't know if you know what is covered bonds. Covered bonds. It was the unique instrument to obtain liquidity during the crisis for Spanish banks. Covered bonds are those bonds that you issue. You know that in accounting you have the assets. What does it mean, assets? Assets mean investment. Equity and liabilities. No? Liabilities is the portion of the assets that are funded by creditors and the portion of the assets that are funded by shareholders. Okay? We develop accounting standard for how to measure assets. We develop accounting standard for how to measure the liabilities, and the equity is the residual, as the same as the residual of our relation. Okay? Equity is assets minus liabilities in accounting terms. We develop how to measure assets in the standard. We develop how to measure liabilities, and we don't develop how to measure equity because it's the residual. Okay? And the residual portion of a company is for shareholders, because are the first that absorb losses. Okay? And I don't remember why I was saying this.
To pay the covered bonds.
Okay, covered bonds, sorry. You can issue some covered bonds, and this, the specialty, what is called, if you want, cédulas hipotecarias was called. And you have, if the bank cannot pay you, you have some specific assets in the balance sheet that are for you. And these assets should have a minimum rating, a minimum quality. And if the quality decreases, you need to put more assets for these creditors.
Yes.
So this, if the bank goes to bankruptcy, to resolution, what is called in banking, so this ley concursal, this Chapter 11 for industrial firms, is resolution for banks. If the quality of these assets goes down because of the macroeconomy, they need to recover more, to put more for these specific creditors. And if something happens, this portion of the balance sheet goes for this, and the rest is for the rest of the creditors. You know what I mean? What we call in Spanish pignorados, covered bonds are called, cédulas hipotecarias. So the unique way that the Spanish banks have in 2012, you were very young at that moment, but was the most horrible situation in Spain, more than 2008, 2009, 2010, because it was the real estate collapse sector, and the European debt crisis impacts on Greece, Spain, Italy, Ireland, and Portugal. Okay? It was very, very hard. I can tell you some stories that I realized as I was director of the Master Banking and Financial Regulation at that moment. That was, the system was collapsed. The funding came from the European Central Bank, and only with this way the banks were able to obtain funding from the private investors, but only with this. If they issue bonds, etc., regular bonds, it was not possible to obtain liquidity in the market, in the capital markets. They were zombies at that moment. Okay?
Going back to the agency raters, how do you guys manage the divergency between agency?
So
How do you guys manage, like going back to the ratings, the agency ratings, how do you guys manage divergencies between the ratings?
well, you need to justify. The supervisor is going to ask you to justify where the difference comes from. Why I saw that Standard & Poor's put BBB and your PD is 0. So how is
Do
possible?
you usually go for the lowest one?
Usually there is an equivalence and there is no
That's
problem.
not the-
And you know that they are going to ask you,
So
but they can check it.
that, because I remember on the crisis 2007, like those kind of related to the ratings that Fitch and all these rating companies were giving to some credits, right? To bonds, I think it was, they were over qualifying some instruments.
Yeah, but this is related to special purpose vehicles that were created by Lehman Brothers in order to sell these financial instruments were overrated in terms of credit rating because they were AAA and in reality they were not AAA, etc. But this is a different story. We are assuming that this is correct. And this is the internal estimate of the bank. But what you are saying, this can be overestimated. That's right. They can get confused. They can, in some sense, they trust a lot in Lehman Brothers to structurate financial instruments in order to sell in a package and special purpose vehicles. These vehicles, they have some skin in the game, Lehman Brothers. And when they realized, I don't know if you watched the movie, when they realized that there were losses in this special purpose vehicle, the engineers realized that they didn't have enough capital to absorb these expected losses, economic capital. I'm going to show you what is economic capital in order to absorb unexpected losses. There are two things that you need to know. Provisions is for expected losses, for expected. We are talking about, we simulate future, macroeconomic analysis. In this simulation, you use the real estate prices, inflation, GDP growth. You know what I mean? We usually use minimum 5 of usual variables, yield spread, that is the best predictor for economic activity in the following 12 months. So you put this in order to simulate. And we say, okay, the losses associated to the macroeconomic scenario are these ones. And then the regulatory capital in banking is for absorbing unexpected losses. Those losses that are more than expected. You know what I mean? That's important. So this is an equivalence that was published by the Standard Chartered. The equivalence in BBA could be different. Taking into account that this is the internal models, the estimate from the internal model. And this is the rating from different agencies. The most important thing as a professional is the way that you justify your professional solution. Is how you are able to justify your professional solution to the supervisor, to the inspectors, to the, you know what I mean?
They're mostly like international benchmark framework.
There is international benchmark framework in the sense that European Central Bank has a confidential database about the other banks. For example, this is a very good question. Imagine that I'm providing financing to Deutsche Telekom. The supervisors know that 3 banks provide funding to Deutsche Telekom. Imagine that these three banks that are providing funds to Deutsche Telekom is without any collateral. The estimated losses should be similar if you are in the same range. You are if you are senior debt or you are junior debt, mezzanine debt or subordinated debt, the three banks are in the same level, the losses should be very similar and they have this information. But this is confidential for inspectors, they use it. I have a lot of previous students on the Master in Banking and Financial Regulation as supervisor of ECB. One works for Italian banks, other for French banks. There is another one from the city I was born that is in the resolution board, supervising the resolution plans of his working in Brussels, because senior resolution board is in Brussels, for supervising the Italian ones also. And they have a lot of information. And the best database in Europe is the database of the statistics in European Central Bank. And the person in charge is Remigio, that is from San Sebastian, Remigio, in fact. They have, this is an important question. When the Lehman Brothers collapsed, Jean-Claude Trichet was at that moment president of the European Central Bank. And he asked about, okay, I would like to know all the European firms and banks exposed to, because I need to make actions. It took 3 days to obtain all the data. And then Jean-Claude said that this is not possible. We need to make decisions in just minutes because the contagion, you need to take into account that the liability for a bank is an asset for the other because there is an interbank market. They run loans between banks. And what is a liability? If I cannot pay you, the market value of the asset of this bank is reduced. And then this bank cannot pay you to the other bank, so the contagion takes seconds in the world. Seconds. Right? And then they need to have this database. And right now, they have all the data about the exposure of every SIM in European companies, how is exposed to a specific company in the world. It's incredible. It's the best database that is in Europe. Okay? It's confidential. So they want to open in an anonymous way, but still they are opening an accredit, and an accredit is or CIRBE, or credit register database in Banco of Spain, that is really, really good because you have in Spain, the credit register have all the data about loans, guarantees, credit cards, etc. of every person in Spain, and also of every firm. You can ask yourself your CIRBE. You know that you can, if you have a digital certification, you can ask, and in some seconds you obtain your credit card, your loan, if you have, I don't know, on every data. And they have. That's the reason that people in the Bank of Spain use this database to make excellent research in a very granular data. And they have another task because in order to have, if we want to have this data, it's very difficult for us. We need to work with people in the Bank of Spain. But in the end, you can develop a project, etc., etc. And a credit is the same at European level. And then the other is for capital markets, investments in firms, etc. Okay? So, okay, do you understand this?
I have a question. For example, like regarding the creditors of a retail bank, what are the main creditors, like apart from?
Well, the main creditors are banks. So 60% or 70% depositors in a retail bank. 60% are us. We have some deposit and it's the liability. Because if you want to withdraw your deposit, you have the right to withdraw, and then we are the main creditors of the bank. The financial intermediation comes from taking money from people, granting loans to the economy, giving your expertise on assess the credit risk, given you are the best expert in assess the credit risk, you are going to generate a positive externality to the economy, taking money from depositors to grant to firms in order to generate wealth, to generate employment, to generate. So it's a positive externality. Working in a bank, you are doing a good job because you are helping the economy, and you need to know this. Why banks in every country in the world are strategic assets designed by governments? Why Germany protect Commerzbank, the stake of Andrea Orcel in Unicredit, purchasing more than 20% of the stake in Unicredit, and they stop the possibility to do a merger? Why? Because banks have contracts on households and on firms. They have information about the economy. If you are a creditor, you have a lot of information. You know what I mean? Yeah? And that's very sensitive. And very important because if the bank becomes larger, they focus on granting loans, large loans, to large companies. And they don't pay attention to the small companies, the small restaurants. Why? Because from regulatory capital and provisions, it's much more efficient to grant a loan of 200 million to a listed company, very large, is less costly in terms of consumption of capital and provisions than to grant 200 loans of 1 million to 200 smaller medium entities of control. It's more costly. So the bank is going to require higher returns on this, and it's more costly on regulatory capital. And you need to know how they think in order, if you are a chief financial officer, you need to know how they are going to deal you and how they are going to calibrate you when you are asking for a loan. Because you need to know that if you are audited, the level of concession of capital for them is lower, so they can make you an offer. The probability of getting success in this loan is larger. So a lot of things that you need to know, the volatility of your numbers, of your past numbers, the track record. If you are a startup, right now the regulation does not allow the banks to finance you. You need to go to venture capital, and we would have a small venture capital, it's difficult. In order to get loans from banks that are the more efficient ones, because it's less expensive than venture capital, or less expensive than, of course, than debt investment funds.
Maybe what's
Done.
like probably called like ENISA, which is like ENISA.
Uh-huh.
ENISA, they give you like in exchange of like some shares, you get like a loan. I think like you don't have to pay it back at the end.
I don't know if you show me the conditions, I can explain you, but from time to time, venture capital, what they do is they purchase convertible bonds, because convertible bonds, imagine.
It's
that-
for this credit loan. Préstamos participativos.
Okay, this is, no,
That's a-
it's not a convertible bond, préstamos participativos is the way that if you do well, I know the interest rate depends on your future performance. I know to obtain more. And préstamos participativos, what is interesting is that this is the most subordinated ones. They are between equity shareholders and liabilities, they are the most subordinated. And in terms of ley concursal or chapter 11, they are classified for not being liquidated as equity, because they are very close to equity. In terms of the computing of the equity that you have, the minimum equity that the commercial law requires you to have. You know what I mean? But convertible bonds, why they use these financial instruments? Because if the market value of the firm increases, I can protect the RAN of this. And if the market value decreases, still I am a creditor. I am going to execute the option, I will be creditor of the company. You know what I mean? So, what is the difference between IFRS and, let me show you, and US GAAP? This was the recurrent loss model. I only recognize the loss when it happens. This is the IFRS number 9. How we recognize the, given that we are going in the last class, we are going to see the effects, the economic effects of our accounting standard that are very important in terms of capital structure of firms, in terms of getting credit from the banks in the economy. In terms of GDP growth, always the Basel for International Settlements make very good research. In fact, the managing director is Pablo Hernández de Cos, and the director of the Financial Stability Institute is Fernando Restoya. Sent me an email this morning because he's finishing this year, in December this year. And what they do is analysis of terms of cost-benefit analysis. If we require larger provisions and larger capital to banks, less credit to the economy. But the crisis, in the period of crisis, the losses will be lower. We can have a more sustainable growth instead of having, if we don't require provisions or capital to banks, it's going to be very efficient. The banks are going to grant more loans, but what happens? Before the financial crisis was very efficient because the capital bank was 2%, 1%, 2.5%, almost nothing. But a crisis associated in a banking system where you have low provisions and low capital will be most costly. The banks will need to be recapitalized and the government need to invest in the banks. Right now we have a single resolution board, single resolution fund to capitalize the bank, etc. We have more tools, but still the banks are collapsing and will collapse. Because in order to generate employment in the economy, in order to generate growth, you need to take money from from depositors to grant loans to the economy to generate. And you are not very good in terms of assessing these resources to the economy, and a significant portion of your borrowers are in default, you will experience a problem. Okay? So, what is the difference between FASB, right? In US, with the expected credit loss model, expected credit loss model in FASB is called current expected credit loss model, CECL, and IFRS number 9. Which is the difference? The difference is that FASB, you estimate the PD lifetime from the beginning. What is PD lifetime? Well, a new concept. PD lifetime, I'm giving you the basics. The mathematical foundation of this is statistics. I can show you, I will show you one example that is more complex than you can think, because we can introduce complexity. Why? Because if I grant a loan to your name? Hanan. If I grant a loan to Hanan of 20 years, he can be in default in the first year, or in the second, or in the third. So statistically, the PD is not. But also Hanan can be in default in the second year, and he can recover in the third year. While I didn't sell this loan to an investment fund. So you need to manage statistics, okay? So when you are calibrating this figure, you need to take into account the historical data and how the historical data related to historical macroeconomic situation in order to simulate how is your sensitivity to the macroeconomic expectations, okay? Do you get it? Okay. So the difference between US and the rest of the world is that they use expected credit loss model that use the PD lifetime. So which is the PD for the 20 years of the loan. But in IFRS we don't use the PD lifetime. We use the PD 12 months. Given that when I grant a loan to Hanan, I can estimate the losses of this loan. I can estimate which is the probability that Hanan is in default in 12 months. The probability in 12 months, if I am good, and my models are good, is going to be low, because I'm not going to grant a loan to Hanan thinking that he is going to be default in the following months. So PD 12 months is much lower than PD lifetime, because PD lifetime is cumulative, can be default in first year or second or third until 20. Okay?
And why there's a jump? Is that 1 year?
Yeah, is that one? This is PD lifetime could increase during the years. would decrease. This is the difference between two models. What are the economic effects? Because accounting has a lot of economic effects, I can tell you. Why the managers ask always about, well, this merger, how are the accounting effects, how are the tax effects of this merger, I'm going to do yes or no, because the dividends are going to be distributed through earnings, through the earnings that you are going to, so they are interested. Here is the same. So this is the PD for the IFRS number 9 that is only PD 12 months. The PD that is, but if the PDDs increase significantly, and in accounting regulation, we are not going to give you thresholds. You are economists. You need to think you're from economic substance. So you need to think, you justify what for you is an increase of PD from 0.10% to 0.15%, whether this increase is significant or not. But until you don't increase, until when the PD 12 months increase significant increase in credit risk, then we will use PD lifetime. And then both models are the same. But only with this. Explaining this, I uploaded the paper that was wrote with Raif Al-Mazhabal, that is the Vice Dean of the ESL Business School of Research, one of the top 3 guys in accounting in the world, and Yuki Sakasai, analyzing the effects of IFRS number 9. Okay? Then there is a difference, but when there is an increase, significant increase in the PD 12 months, both models are the same. Okay? In the appendix of this paper, you have how you are going to recognize loan loss provision in one model and the difference with the other models.
So let's say that doesn't happen, like the deterioration of the PD, then the line will always stay below the blue one, right?
Yeah, and the first always low, and it is low, which is the economic effect of this, that the loans are going to be cheaper here than in the US, because the way that they are using from a regulatory point of view, they are assuming a larger cost at the beginning.
And then it will just, the red line will continue straight, right?
Absolutely, that's more linear or more smoothie, the pricing than in Europe or in Africa or in China. Okay? This is IFRS number 9, which is one measure that the analysts pay a lot of attention on banks, and you need to pay attention. The cost of credit risk, which is the cost of credit risk, loan loss provision over total loans. This is the cost of credit risk.
Can we interaction?
Sorry?
Que si podemos encender la luz. Que si podemos encender la luz.
Yes.
Un cambio.
I'm going to make a break in 5 minutes, okay? Sorry, I didn't know. So the cost of credit risk is too much? The cost of credit risk is an important measure of important measure for analysts to analyze the financial health of a bank. Okay? If it increases a lot, the bank is experiencing problems in terms of credit risk. Because loan loss provision is to cover expected losses, expected credit losses. Okay?
LP over
Loan loss provision over loans, total loans. This is a very important measure to say, and this is in comparison IFRS number 9 with the previous incurred loss model. In the incurred loss model, you only recognize the problem when the loans are NPLs, non-performing loans. You are going to recognize the non-performing loans in this situation when they are in default, but not before. In IFRS number 9, you are recognizing little by little. There are 3 stages. Stage 1, when you grant the loan. If there is a significant increase in credit risk, you move to stage 2. In stage 2, you apply PD lifetime. Sorry. PD lifetime, and here is PD 12 months. Okay?
In the formula for credit risk,
Sorry?
in the formula,
Yeah.
so if the number of loans increases, why the cost of credit risk?
Well, this is the average. Well, this is the average.
Should
loan.
like increase if there's more loans, the cost of credit risk is much higher. No?
No. This is the average loans between the beginning of the quarter and the end of the quarter. And this is the loan loss provision during the quarter. Of course, if there are an increase in new loans, this loan loss provision for the part of these new loans is low because you are using PD 12 months. But on average, you need to take into account that the bank in the balance sheet have billions of loans. So the supply of loans in a quarter could be 2% or 3%, not more. And these new loans, from economic substance, taking into account economic substance, the PD will be very low because you are applying PD 12 months. But on average, the financial analysts take into account this because they don't disaggregate. They are not going to give you data about every loan because you have billions or millions of loans, billions in euros. Okay? You know what I mean? So it's a measure that is not perfect, but it gives you some idea about the financial health of the bank. Okay? So the difference between Fast B and IFRS, I told you that here we use PD 12 months and here we use PD lifetime. Okay? When there is a significant increase in credit risk, because imagine Jose Maria, that I run loans to a specific region, Navarra, and Navarra suffered a shock in the industry of agricultural firms, and I have a lot of loans on agricultural firms. There is a significant increase. We need to change this portfolio to PD lifetime. I need to estimate the PD like 12 months for this portfolio and also the PD lifetime. It's going to be more costly for the banks. And then when it happens, the loans to this sector are going to be expensive because the bank needs to make a larger provision. And then more expensive in the pricing. You know what I mean? That's
So it becomes more expensive for new lenders, but also if the existing lenders they have variable rates, that will also increase.
no. The contract variable rates are linked to Euribor or to other interest rate, LIBOR, etc.
Yeah.
Usually here in Spain in Euribor. So I only link the variable interest rate to this. What it happens, the other way, the market value of these loans decrease because the PD has increased, and if someone, third party, wants to purchase this loan, is going to be able to pay less because the credit risk has increased. You know what I mean? So, sorry because you ask a lot of things and then just 1 minute, okay? So, we're going to make the break. I studied first statistics, and I can tell you that one of the most important things in your life is probability. When you decided to come to the University of Navarra, why? Because you think that the probability to obtain a good job is larger than in other places. When you are going to get married, because you think that you are going to live with your husband or with your wife the whole life, and the probability that happens something is lower, no? So when you come to Spain, it's because of you think that the quality of life of the country, or you are going to feel yourself well here, the probability associated to this is larger than in other parts, perhaps, or no. So in the end, we calculate every day when you take this road or the other, implicitly you are calculating probabilities without knowing that you are calculating probabilities. The same in the banking industry, and in the insurance industry, in the financial industry. Okay? When you are studying my topic in order to reduce the probability to fail, you are studying because of you want to reduce the probability of something bad happens, no? So fail. Okay, you know, so always we can model problems of probability, and that's important. Okay, so we are going to make a break of 20 minutes. Okay, is okay? And then we go back.
对，一个选的是金融，一个选的一个经济，然后选的是金融。
Yeah. Very boring, no? Very boring. Non-performing loans are 0.7%. Why? Because JP Morgan and investment banks only provide funding to very large corporates that are internationally diversified, that they know very well, they are their clients, etc., etc. And they provide to very specific companies, very large, or countries. So in this case, the NPLs, because the investment bank activity is very secure, so not providing loans to households, not providing loans to SMEs, not providing loans, very specific loans to companies that are listed and are very large. Okay? More things. Deutsche Bank is an animal that had problems, experienced problems 5 years ago, and everybody thought that if they have the implicit guarantee in some sense of the company, the market capitalization has increased a lot. In 2020, before the COVID, the market value was around 16 billion, and right now it's 64 billion. Imagine, So it's 4 times in 5 years. Okay? And then related to the size. Net interest income is 15 billion, non-interest income is 16 billion, so it's very close. Why? Because they do a lot of non-interest activity, okay? They are advisors in IPOs, they do a lot of, they obtain a lot of commission fees, etc., related to subscriptions, etc., to some specific transactions for firms, trading activities, etc., etc. So, and the case of NPLs, I don't remember, but should be very similar to UBA, I hope. You can see that the return on assets, I didn't mention return on assets in banks is very low because you have huge amount of assets, and the assets are contracts, papers, loans is a contract. You are measuring contracts. That's important. Thinking about. And usually a good return on assets is 1%, 1%, 2%, like UBA. They have 0.4%. They are not creating value still because the return on equity is 7.6%, less than the cost of equity estimated by Capital IQ. So they are not creating value. They are destroying value for the shareholders, but given that they are important for their country, is important. And then the non-performing loans is 3.1%. So in line with the others, okay? So let's go.
In which category does the bank like Merrill Lynch will fall in?
Sorry?
Which category does the bank like Merrill Lynch will
Merrill Lynch was purchased by Bank of America, so now it's consolidated in Bank of America. So I don't know the metrics. So it's part of Bank of America. If you want, we can. If you want, we can download the data financial statements analysis of Bank of America this week. Okay. Remember me because I'm getting older and then I forgot it. And then send me an email, not through any platform because I hate to any platform because I cannot answer. But send me an email, not tomorrow because I will be very busy, on Monday. Okay? And then I will download. I try to be very practical. So right now, I'm going to show how to extract data from all these databases. Let me to send an email because I have a meeting with my student, one of my students. I put 7:35, but I think it will be 7:40. Okay. So I'm going to show you. Was crazy for me. So I started my teaching for undergraduate, my teaching for colonialism in the first semester in Madrid, and then I had to do a lot of things. So I'm going to show you how to download data from banks and from other firms, from all these databases. You're going to learn all these databases, but one important thing for next week, I would like that you extract data. I always try to be very creative for students. You need to extract data. You need to get from central bank from Russia the inflation. Inflation is high. It was decreasing, but it's like this, but it's still high. It's 8%, 9%. The level of inflation. You in Central Bank of Russia, you have the level of loans, but amount until 100,000 billion of rubles. I don't know the rubles. This amount of loans, etc. By different, but this is not important. But you can get this information. It's also for that.
What information?
No, is about how much borrowers are in the level of more than 100, imagine, I'm going to say in euros, below 50,000 euros, above 50,000 euros, above 100,000 euros, above 150,000 euros. You have this information. I would like that you see the level of inflation, the interest rates. You have the level of interest rate. That is very high, around 60% right now or 70%. You have those contracts. How many contracts do you have? At 5%, at 6%, at 10%. This is good for our economy. It's not only the real one. Then you have a lot of contracts with the economy at different levels. This is in Central Bank of Russia. You ask ChatGPT. This gives you the link. I tested this morning. Okay. Okay, so the interest rate, you have the graph of interest rate, okay? And you can get also additional information about how is the population. And then, through all this, you are going to extract some data. I would like to see that you compute NPLs. Is not you have the non-performing loans, but not divided by total loans, but you can create variables. I uploaded an Orbis that is old, and you're not going to extract the same result, but the way that you can extract data from accounting data from the financial statements is exactly the same. I'm going to show you. NPL, return on equity, return on assets, net interest margin, tier 1 capital, level of loans, of all the banks that are in Russia, located in Russia, with total loans more than 1 billion of euros, okay? And then I would like to analyze whether you trust these NPL ratios, and this return on equity, and this net interest margin. What do you think about the numbers? Okay?
What is it? That one?
The loans, Tier 1 capital.
Tier 1.
Well, but Tier 1 capital is not, I'm putting some variables, I'm going to add little by little during the class, eh? So, but I would like a professional judgment about what is your, you can read in newspapers, in, I don't know if you know Russian or whatever, or English, well, English. You can, but I would like to develop your professional judgment. I always put some things that could be, especially what happens in inflation after the invasion of Ukraine and the interest rate, and how you think that is going to affect the economy and the banks, because the banks are very important. Also, you can see who are the shareholders of the largest banks. The largest banks belong to the central government, to the government. I would like that you develop your professional opinion about this. It's nothing against Russia, in favor of Russia, it's just analysis. You are an analyst, okay? Okay, if you want to select China, that you are an expert, you can do it, okay? Because, so it's, and then you need to compare with the ratios in Europe. We saw that the NPLs in Europe are around 3%, right? And the return on equity, maximum is 19, minimum is 10%, 7% goes back, etc. I would like your feeling, how analyst you are. I don't want that you make a perfect project. No, it's only your opinion, your professional, and how do you justify your professional opinion. It's the most important thing for being a good professional. You need to be clever, extracting data, analyzing, and you have some things that the most important thing is your attitude. On Saturday night, you will be working on this, saying, okay, I'm going to learn something. It's the most important thing in your life. If you are excited by this type of things, you will be good in your profession. You need to find your passion. If you find your passion, you will be a good professional. Independent of the grades that you obtain before in the undergraduate, in the master, etc. You need to find your passion. Right?
Yes.
You will find it. For sure. So I'm going to show you how to do it. But I don't know how to manage this. This is horrible. Okay, you go to the library. Depends in Spanish or in English, library. Database. Okay, are you following me? You can open the laptop right now, right? The other nominal I allow you to test. And ChatGPT makes the graph of inflation and interest rates, etc. And the link to how to obtain how many loans are between 5% and 6%, etc. So, obviously, we select Kenya in the future. You can select one, this one, because we need to work with Kenya. So you can select this, because I don't know. This is interesting because you have a shop that is a word, and then they need to finance the word, and then I would like that people make an analysis. You cannot imagine how the content important is. I can tell you, you cannot imagine. I'm not saying that the content is the most important thing, but if you know a content, you can extract a lot of information of who are the shareholders, who are the network shareholders, which is behind this movement, and who is behind this movement, etc. Okay, we select Orbis database. Are you there? Okay, are you here? Eh? Do you follow me? It's low because when there are more than 5 people, this so let's go for selecting firms in the, for example, in the we can select global B sectors and we can select construction, okay? Because it's the example that I put in. And then we are going to select construction all around the world. We have 36,000 construction firms. You are going to be an expert on real estate firms. Then we have a status, active companies and unknown situation. We need to delete this in order to delete the survivorship bias. When you are doing empirical research, you cannot select only the firms that are active right now in 2025 if you are going to analyze data from 2012 to 2024, because you are selecting the best ones. You need to select the firms that were active every year, so you need to delete this. Do you follow me?
No,
You know, when you are doing empirical research, you cannot select only the firms that are active right now, because there were firms that were liquidated in 2024, there were firms that were liquidated in 2022, there were firms that were liquidated in 20. That these are endogenous, they are the less profitable, the less solvent, etc. You need to take it account because we're active in the past. I mean, you need to make an empirical analysis from 2012 to 2024. You need to take into account all the firms that were active during this period every year. Okay? Not only the firms that were active during the whole period. No, the firms, all the years. So you need to think all the firms that were active in 2012. All the firms that were active in 2013. Why? Because you cannot delete those firms that were into bankruptcy in the future, because if not, you are creating a survivorship bias. What does it mean? That you are only taking into account the good ones. No, you need to analyze all the sample, okay? You cannot introduce bias in the sample. Okay, let's go for selecting those that are listed. Publicly listed companies, okay. Then we have 2,000. And then we can select the geography in Europe. Imagine, location. We can go to world region. We can select, I don't know, I go fast.
Too fast. Yes, I don't know.
Yes, that was too fast.
That's my intention. You go fast and you say, okay, so I go here. Are you here?
Yeah.
Eh? No? ¿Dónde estás?
Todavía no ni siquiera. Wait, you can go.
No, but did you select the Burobandi sector?
No.
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 Industry.
I have a question,
Yeah.
like how to change my language to English, because now it's Spanish.
But you are Spanish, right?
No. My computer now is in Spanish, but I can to change to
You
English.
you can change from here,
Okay.
but
No, in
I mean,
monitor.
you can translate.
Yeah.
well, in translate you can use, but also you can change here, but you are going to change the language for all the people that go to the database after you. So, because this is the account, you have the same account as you and me. You know what I mean? I think.
You can change
Thank
the
you. Sorry, no, it's not the same.
Are you not the same?
No, that's not what it is.
Okay.
I'm happy for
Oh, okay, you are right, you are right. So you can change here manage account, and then you can change the language, right?
Okay.
Language is here, display options.
反正有一点儿。啊，这样好。Alright, it's good.
Here, language.
Yeah, we got it.
Okay. You can test in at home, so I'm here. Are you here?
Yeah.
Can you select Buroman these sectors? Is clicking on activity as industry, then you select Buroman these sectors and the 13. And for listed companies, stock data, which is your name? I don't remember your name.
Lucre.
Lucre. Lucre. But are you?
Now yes.
Yeah. Okay. So Lucre. So stock data, listed companies, and then we are going to select location, world region, political region, I think. What is it, European Union?
You can type it.
Yeah, including four, I don't remember. World political regions. And then European Union 27. Okay? And then we have 169 firms, right?
Can you be the one of
What?
listed?
But it doesn't matter, so you can
It's
follow.
for
But it is here in location, world region, then you select world political regions, and then, okay? So you can click on view results, and then you have by default this
So,
data.
which one we select, the countries? European Union.
27. Okay. So you have this data. If you click in these firms, you can get the data. You can get the data. We can put a conditions that the total loans should be larger than 1 billion, etc. The condition that you want. Here you have, if you click Vinci, you go to Vinci data. You have here all the data about information, who are the shareholders. For example, this is important for here, who are the controlling shareholders of this firm. These are the shareholders of this firm. You have here, and you have the current subsidiaries of this company, the investments in other countries. Here you have 10 levels of consolidation, because you have a firm that the parent is here, is A, for example, and owns 100% of B, and B owns 90% of C. The percent is owned by X. I don't know if you study consolidation. I think consolidation is another thing that is really important in your life. You want to be investment banker or financial analyst. This is the first level of consolidation. This is the second level. It appears until 10 levels of consolidation. You have which are the subsidiaries of the group, and you have the data about the group. The controlling shareholders, the historical shareholders are important in order to analyze who are the shareholders that are controlling this group. Okay, this is also important. You can do an analysis, etc. But go for the selection that we made. Here, if we want to introduce the variable that we are interested, we select here add remove columns, and then we are going to select the variables we want. For example, imagine that I want to add country. The country is a code in 3 words.
Is there ESG scores in here?
sure, but it's not the, in Capital IQ you have a special
I
subscription.
just like icon, representatives.
Yeah,
Yeah, but
they have,
Like
you can structure.
I wanted the store, so that's why I was asking.
I never use ESG score from this. It's more for accounting and some market data. You also have access to market line here. Market line is database about deals, debt deals, equity deals, etc. You have here access, it's free for our students. And Orbis is the most important database that we have in the sense that cover all around the world. So here we are going to select financial information. For example, imagine that we want, this is a corporate, so I want to select the operating revenue. It's always the same. Please pay attention to this because this is important. When you select one variable, you have more than 3,000 or 4,000 variables. When you select one, please click here, put in absolute terms, and analyze. For example, when you are selecting the Russian banks, I would like that you select 2020, 21 before the invasion and after the invasion. 2023, 2025 you will not have because still they are not ready to be presented. Okay? From 20 to 24, you select the currency. By default is US dollar, but we can change to euro. In thousands, okay? And if I put save, now I have operating revenue of this year. Okay?
After profit and loss account, where do you go?
No, but you can go wherever you want. You have a-
And you were.
no, here I select this and I select here.
And you were.
Yeah, you have a lot of information. For example, let's go for profit and loss after tax. Okay, I select this, and then given that I selected the period, the database interprets that you are going to select the same period for every variable. Okay, so then, and the same currency. If I select profit and loss after tax, they are going to put the same. Okay, when I change from the folder, the database is going to ask you again the period and the currency. Okay, for example, for balance sheet, I'm going to select total assets. Okay, total assets. I'm going to again review that is the same period, the same currency, the same thousand of euros, and then I set. Okay, you have selected a lot of data of here, shareholder funds. I select it here, and then you can build your own variables. I'm not going to say you how, because I put it. I don't know if I put it in the. But it's very simple. Okay, and you can find variables that you want to use. This is a construction field, they don't have non-performing loans, but if you are looking for banks, you can get it, okay, the non-performing loans. So, and then if you apply, you are going to obtain this data. And you can download and you can analyze, okay? Okay? For example, imagine that we are going to do another research for banks. For banks, what you can do is this one, activity. For Russian banks, you select listed and unlisted and non-listed, because some of them after the war were moved from being listed to unlisted, for example, as a bank. Yeah? So activities and industry. We can select the 6419 is the banks. I know I told you, you need to use this one, that is the one for banks, okay? I'm going to delete this because this is universal bias. And go, imagine that we want to select those banks with more than 1 billion in total assets. For example, so we can put, we need to select, sorry, the view. Sorry. If we want to select listed banks for Russia, we are not going to select, we can select these ones. And then, if you want to introduce, let me to look for, where is it? You can select for ownership that the ownership is from government or from private. You shouldn't filter anything related to this. Let me to global ratios. Here I'm going to try to non-performing loans. You can look for some variables here. You have here impaired non-performing loans. But no, I want to select the loans. Sorry, to have net loans. Net loans. Net loans and advance to customers. We are going to put a minimum of 1 billion, 1,000 millions in euros, for example. Okay? And then we are going to introduce this. For the Master in Banking and Financial Regulation students, I created the non-performing loans variable, how to extract, but I would like that you work. I don't know, some from time to time, it's saved there, and you can get it if you go to save variables, because it's for the whole database. But then we have 746 banks, listed banks that have more than 1 billion in total assets. That is very small, 1 billion, so it's not. And you have this, okay? We can add, there are some variables that are non-available, but we can change the variable that are not available to others. So these are the ones that I don't know why, because perhaps it's net income, but I should put. So I would like that you work on this little by little in order to extract data and to make some, to do some analysis. Okay? You can add the variables you want here. Okay? And that's important. And you can filter to variables. Okay, because I put the variables for construction firms and then I use this for banks and they are not the same. They have another names. Okay, I know that. I need to remove all this. Okay? And I need to create, for example, for financial data, I need to go to, instead of corporate, I need to select that they are banks because the name of the variables are different. Okay? With this, I would like that you start to download data for your final project, for whatever you want, and to make an analysis, I don't need a report. I only need your professional opinion. For me, it's the most important thing that you can learn, that you are able and you're free to download data, to think about to the graph of inflation and etc. How should affect this level of inflation, this level of interest rate, to the quality of loans that you grant to the economy in a country that is in a war, involved in a war. Also, we can analyze Ukraine. Okay, but select Russia and tell me which is the difference in terms of non-performing loans to Europe, or what do you think in terms of return on equity, in terms of net interest margin. Okay? Okay? So see you next week. Okay? It's difficult to
Sí, pero quiero verla nueva.
José María, ¿esto lo puedes devolver?
我上一个刚写完，我上一个作业刚写完。 我也有作业是吧？
Más familiar con los conceptos.
那你什么时候
Hablamos Puerto Rico.
Of these scenarios, and then it could be around here. Okay? It could be around here. And the other should be absorbed by regulatory capital. Unexpected losses. The percentile is 99.9%. Is imposed by regulation. The regulation of capital and provisions is very statistics. If you read the law, or so the implementation of Basel is for normal distribution, for line distribution, etc. So it's a statistic, because in the end you are taking data, historical data, and you are simulating, taking into account the expectations of how sensitive you are to specific shocks, macroeconomic shocks. Okay, so in a way, it's very similar to an engineer one day, or an architecture, when they compute the resilience of one bridge to all natural disasters. In the end, what are you doing? You can have a bridge that is resilient for the next 200 years, but it's going to be very costly, right? So if you put more material there, it will be very costly, but it will be very resilient. We do the same. From a statistical point of view, it's the same. We need to have enough provisions and enough capital to absorb shocks, okay? Every bank. And the whole system, the provisions of the whole system, and the regulatory capital of the whole system is the resilience of the banking system in order to absorb losses. The problem is that the crisis could come from another country, from another region, from another deregulated region, that they don't have enough provisions, but you have some interbank loans with them. So the contagion in the banking industry is very fast, and we need to take into account this. But there is a loss that we are going to be able, that is not absorbed by the capital, because for sure you can say, okay, 20% of provision and 80% of capital, but this will be very costly for the economy. Larger the capital requirements for banks, lower the credit in the economy. If you ask 100% of the assets immobilized to grant loans, you are not going to grant loans to the economy, okay? With the deposits of depositors. So you need to take into account which is the threshold, the optimal threshold. And this is what the Bank for International Settlements does. They calibrate the necessary provisions and the necessary regulatory capital in order to be able to absorb expected losses and unexpected losses. Then we are, after the crisis, we are requiring more provisions and we are requiring more capital. We are, the probability associated to crisis is lower, just because we were more resilient to COVID, because of the banks are better capitalized. Another thing, because it was a systematic shock. It was a shock for longer ago. Then the coordination among the institutions was much easier, and much more effective. The coordination among international institutions. Okay? The coordination is very important, because if everybody has a problem, we can solve the problem in a very easy way. I remember one banker, important banker of this country, that he always explained me the situation where Santander purchased Banco Central Hispano, and they have a huge problem with more than 35% of the NPLs in the balance sheet of Santander Central Hispano. And they realized with the video team and Alfredo and Jose Moran realized that they had a huge problem. What did they do? What did they do at that time? That we have national regulation, not European. From time to time, the solution is to make the problem larger, to purchase other banks in other countries, and then Bank of the State can manage the crisis if you are so systemic, and then you can solve the problem. But this is not for, this is a real situation that happens a lot of years ago, and it was very good decision. At that time was tax deductibility of the goodwill when you invest abroad, etc. There was a specific moment when the Spanish companies went abroad because of tax deductions. It's very important taxes, corporate taxes, personal taxes. You need to know a minimum knowledge. When you are more holistic, your pricing in the market is much more larger. Okay? It's the same in the academy. The pricing of the wages here not, and the public university is not, but in the business school is different if you teach finance or you teach economics, etc. Usually, the people in the business department are much better paid, well, better paid, because of they need to know some from economics and also to interact with other areas of knowledge. Okay, and the market is different right now. 30 years ago, it was not the case. So, economics is very important, but also you need to add in the package knowledge of other areas. Okay, I think this is my suggestion. Okay. The more holistic you are, the more market value you are going to have. And the best way also, you are able to justify your solution in the modeling, in etc. So if you are good to justify your professional judgment, you are going to be a better professional. And that's very important, okay? Not only technicalities, also soft skills are very well paid in the market, and you need to acquire these soft skills also, okay? The most important one at your age is art technical. Why people do MBA, an MBA in the US business school after 3 years, or after 10 years of working, especially engineers? Why? And this is a market. Because after being very technical, they need to learn how to make managerial decisions at the executive level, because they want to be promoted. Because when you are technical, after 10 years, after 20 years, you need something else, okay, in your life. And then you want to be involved in managerial decisions, and then you need to know other areas, and then that's the reason that you work with simulated real cases where you need to make a decision, and it's not, you have a lot of uncertainty, and then you need to learn how to make decisions in this situation, okay? But this is my opinion, I can be wrong, but this is my experience, my opinion from my experience, okay? So, what happens in a crisis? That, if the crisis is larger than we have in a financial crisis, then the function that you estimated of losses is larger, and then the provision that you make is not enough. You need to increase the provision, and then this creates a capital shortfall. And the reason that the 99th percentile losses that you are covering is not here, is here. So you need to recapitalize the bank. Because when you increase the provisions, you have less equity, so you have less capital. So you need to take into account this, but this is important. Economists, when Andreas Leifer came here 3 or 4 years ago, he's the most important economist in the world, or the most cited economist in the world. Okay, he's finance. He's a professor in Harvard in finance. He came here 3 or 4 years ago. We were talking about this. 5 minutes, okay? Usually, economists say that credit losses come from because you are relaxing the credit standard, the credit. You are relaxing the credit rules in order to give credit to the economy, and then you are giving some credit to people or to firms that the credit risk you estimated in a bad way because the credit risk is larger than you expected. And then the borrowers are in default, and then the banks have a problem, and then the banking system has a problem. This is when you larger the credit in the economy, you are hitting the economy, and the probability of a credit recession is larger. But if you look at the last 70 years, all the credit crises are very dangerous because the system collapses and there is no funding for the economy, and this is a problem. You need to think that 80% of the credit in Spain comes from banks. 80% in the southern European countries come from banks. In the US is 40%. 40% from banks, 40% from the capital markets, and 20% for other channels. But we are exposed to credit cycles. We're very, very, very exposed. So we need to be careful with this, very careful with this. So if you look at this ratio is the loan loss reserves. Loan loss reserves is not loan loss provision. Loan loss reserves is the accumulated loan loss provisions in the balance sheet. So the coverage that you have in order to absorb expected losses. If you look at this ratio, loan loss reserves as a percentage of loans, is not the cost of credit risk that I showed you. It's loan loss reserves, the accumulated portion of provisions that you have. Loan loss reserves against loan loss reserves, against loans, total loans. This ratio, if it's larger, could be because of the loans in the economy, in this case, are being reduced, or because you are increasing the loan loss reserves. If you look at the periods before the crisis, the huge crisis in US, you will see that this ratio has decreased before having a banking crisis. What does it mean? That you are less ready to absorb expected losses. Given that you change the regulation in order to reduce the loan loss provision, it was good for the economy, yes, because the pricing was cheaper, but it was bad if you have a crisis. It was cheaper, the credit in the economy. Good, generate more economic output, more employment, more GDP growth, but at the cost of a higher probability associated to a future financial crisis. And that's the problem. When a system is not ready to absorb expected and unexpected losses, you will have a huge problem, because to recapitalize the banks is very costly for the economy, and then it takes time to recover the confidence on banks. And it's really, really costly, okay? As you saw in the financial crisis. Here, you can see that this reduction of this ratio means that you have loss reserves to absorb expected losses in loans, and then if the business cycle changes, you have a serious problem. Then during the crisis, you are requiring more loan loss reserves, so more expense in the profit and loss account when you have less income. So horrible problem. You are requiring more provisions, that is expense in the profit and loss account, when you are obtaining less income from the interest because the borrowers are in default and are not paying. So this is the cyclicality that generates a crisis in the banking activity. And then you are less able to run loans to the economy. That's the reason that it's important to estimate well the loan loss provision in order to be less sensitive to the business cycle. It's important to increase the provisions during the good terms in order to reduce an expected model. If you are developing an expected model for the next 5 years, you are ready for, usually you calibrate well. There is always unexpected macroeconomic crisis and unexpected macroeconomic shocks. But you are less ready to absorb these expected losses. You know what I mean? And the same in the financial crisis. The same, exactly the same. Always we have the same problem. It's not only because there are a lot of loans in the economy, And Andres Leifer loved this graph when we were talking about this. And I said, this is real. What happens in, and it's not because this graph, I was invited to a seminar in Bank of Spain 3 years ago. No, 3 years, no, 4 years ago. And one person from the Federal Reserve took the graph and I love it. I didn't make this graph, to be honest. This person from the Federal Reserve, it comes people from the BIS, from the Federal Reserve, we have some parts about provisions. It was when we were implementing the IFRS number 9 1 year ago. No, it was 6 years ago, 2019. And it is real. When the economy is not ready to absorb expected losses and unexpected losses, we have a problem. Okay? It's true that if we require too much provisions, too many provisions and higher levels of regulatory capital, we are less able to grant loans to the economy. There is a difference between solvency and accounting. We have point-in-time estimations. What does it mean? That we estimate the PD right now and the LGD right now. The solvency rules, because for capital, we need to apply not accounting rules, solvency rules. For provisions, we apply accounting rules. Accounting rules is you need to estimate the PD and the expectations of macroeconomy at this moment and the LGD at this moment. For solvency rules, we are not going to apply point in time. We are going to apply through the cycle. And then, one interesting question for solvency rules is that the LGD we apply is downturn. What does it mean? That the LGD that we use in accounting is the real one, estimating the loss given default is something called as today. And something called as today takes into account the real estate prices right now. But LGD for solvency, for computing the regulatory capital, is the LGD from a previous crisis. In order to stress, in order to increase the capital requirements. You know what I mean? In order to increase the capital requirements, they use LGD downturn. Okay?
Like the worst case scenario.
Yeah. More or less, but this is calibrated with historical. What was the loss that they have for the borrowers that collapsed in 2008, 2009, 2010? You know what I mean? It's for solvency because they are more prudent than in accounting. In accounting, we need to reflect the economic reality, and for solvency reasons, we need to reflect to be ready to absorb losses in the worst case scenario. Okay? But the worst case scenario is only LGD, not PD in solvency. PD is the PD that you estimate for accounting and solvency purposes. You know what I mean? Okay. So now, how we can see, sorry. Let's go for financial statements of banks that are different to others, and this is important. So usual financial statements of banks could be these items. This is not a real liability side of a bank, commercial bank, of a retail bank, for example, Santander BBVA, because deposits is around 60%, 70%. But it could be the case of an investment bank. You have some cash, some interbank loans, the loans that you give to other banks. You also get funding from other banks, so interbank liabilities, because the funding that comes from other banks I need to pay back, and then it's a liability for me because it's an obligation for me. You have the loans is 60% for a retail bank, is 20 for an investment bank, 15 for an investment bank. Market assets, you purchase some equity shares in
So
of a
you're
company.
giving loans? This is
Sorry?
loans to other banks, right?
Loans to other banks.
You said
And
20%.
interbank is interbank loans. The loans that you grant to other banks. And this is the loans to the economy, to
Oh.
firms and households. Interbank is interbank loans, okay? So no other. You can have some deposits in the European Central Bank. So here is cash, or deposits because it's an asset. You can recover this deposit in the European Central Bank. Okay. You have equity. Before the crisis, it was 2%. Right now, is 7-8%. Then regulatory capital, we need to apply solvency rules that are different to accounting rules. We have some hybrid and subordinated debt, the riskiest, the closest to shareholders. This subordinated has a larger interest rate because this is the riskiest liability for creditors.
The interbank loans, the interest rate of the interbank loans, is determined by.
No, by you grant a loan and you put the price.
But the central
Usually the Euribor is a reflection of interbank loans between. But Euribor, what the people don't say, that is not empirical data. It's a questionnaire about which is the interest rates among banks.
I thought the European Central Bank had some influence on the interbank.
Yeah, the European Central Banks oblige to banks to quote the Euribor in order to compose the Euribor, because after the Libor scandal, no bank wanted to make this quote because could have a reputational effect whether they discover that it's not very efficient, the quote that you are sending to the European Central Bank, because the Libor scandal was that some banks manipulated the Libor interest rate in their own benefit. Okay? And it was a scandal. And then the banks, I read a letter from some Spanish bank that said to the European Central Bank that they didn't want to participate because it's so voluntary. The European Central Bank answered telling that it's necessary that the largest banks in Europe participate in this questionnaire in order to estimate the euro. You know what I mean? Yeah? This is important. So this is, we are going to see the balance sheet of a real banks right now. Okay, banks are different to corporates, very different. When you study in your undergraduate studies, you can see that the corporates have the asset working capital and fixed assets. Okay, you have the equity and net debt. For corporate, the most important thing is sales, turnover volumes. You have the EBITDA. The EBITDA is a proxy for the wealth that you are generating. It's not a perfect proxy. It's earnings before interest, taxes, and depreciation. It's a proxy of the cash flow. Free cash flow is the most important proxy. Okay, but EBITDA is because earnings before Modigliani and Miller, before interest. So the structure, your capital structure does not affect the market value of your firm. Then we exclude interest. Your location is not important for valuing the business because you can move your business to a location where the tax rate is lower. So we exclude taxes. And we exclude depreciation and amortization because it's the most discretionary accrual. What does it mean accrual? That you can manage the amortization or the depreciation depending on the earnings, that you can do earnings smoothing. So we extract these figures, interest, taxes, depreciation, because we want a measure that is less manageable. In the end, managers try to manage this, I can tell you, but in the end, this is important. Free cash flow is important and before interest. But EBITDA is not important for the banks. It's nothing for the bank, nothing. Banks focus on net interest income. What is net interest income? They obtain interest for loans and they pay interest to deposits. This is the spread. So the spread is the net interest income, what they learn from the traditional activity of our retail bank. There are other activities, investment bank services, subscription services, fees related to commissions, fees related to IPOs, because banks can help in IPOs, assurance of the price in the first days of an IPO of a company. These other things are included in the box called non-interest income activity, non-interest income. Okay? If you look at the Spanish banks, how they have increased the market capitalization last year 100%, 80%, 70%, because what was after 2022 was good years when the interest rate increases and they reprice the contracts and they are obtaining larger income through the larger interest rates in the contracts with variable interest rates. So you have net interest income and non-interest income. We are going to see right now different banks, different business models, how important is this part and how important is this part. For JP Morgan, etc. I selected ones, but I am always open to my clients, that you are my clients. The only thing that you cannot decide is your rate. Okay? By the other things you can decide. Look, I would like to have a look to UniCredit, to wherever, to a Chinese bank, I am open, or to whatever. Okay? Because for me it's important. Okay? So and I'm going to show you how to use database, but here is not very easy to do. We have all the classes here in Seminar 2022.
I hope we not.
Okay.
I like the
nice.
But I don't like to, because it's horrible.
Yeah, next Thursday we have the same, but
We can talk
The
with
same?
them, maybe
Yeah, and
ask for a change.
yeah, all of them are here. I don't know how
So
much.
it's more difficult to
That's
do
right,
here.
change it.
M3 is better, yeah.
Yeah,
Who is the representative of the class?
She's not here, but I'm gonna text her.
M3 or M2.
Because at this time it's difficult that we have, we don't have a space or, I don't like to use, because to explain you how to use the database here, I don't know how I'm going to do it, but. Okay, so here, the important things are net interest income, non-interest income, and loss provision. And these are the basic things that you need to take into account for, you need to take into account also the non-performing loans, which is the average of non-performing loans over total loans. Why? Because the non-performing loans are the toxic assets, those borrowers that are not paying you. Sorry, please. Non-performing loans over total loans. I will ask Carmen Puerto, that is a very nice person, whether we can manage another room, because this is horrible, okay? We can do, well, horrible. But otherwise, it's not bad, it's not that bad, but for me, if I need to see, to show you how to use the database, is more difficult here than the regular class. But I am sure that given that you are split between econ track and finance track or banking track, it's more difficult. So non-performing loans over loans is an important measure of credit risk of the bank. Okay, so in the non-interest income, we have fees, income from asset management fees, payment services fees, other fees, trading gains and losses. We have in the operating expenses the wages of the people that work there, and also we have the loan loss provision that is below net interest income and total non-interest income. That is the most important expense, specifically in a crisis period of the profit and loss account. So this has been very well analyzed in different countries. The literature focus on loan loss provisions, and we are going to see in the last class. In the last class, I'm going to focus on empirical research about loan loss provision, because after me, Sergio is going to explain how it's going to affect the credit into the economy, how is
So,
measures of credit. Okay.
So you get the pre-provision profit, basically it's like the operating profit for a company, and then the loan losses that you were explaining, right?
Yeah.
The blanket, like the mattress.
This is-
like the loss.
Yeah, you can think in this way, but loan loss provision is an operating expense in the banks,
Yeah.
because it's the most important one. It's related to credit risk. is the one that is related to the core risk that the bank has to manage. What is a bank? Is an expert managing risk, nothing else. And pricing risk. They are the expert on pricing. Why is it important to work in a bank before being CFO of a company? Because you are going to work in an institution that they are experts on estimating and metrics related to risk. Liquidity risk, market risk, counterparty risk, credit risk, reputational risk, counterparty risk, more interest rate risk, etc., etc. You have a lot of risk that you need to manage, and in the end, you need to price. When you are estimating, you can price this risk, and that's important. Right now, the risk of pandemic risk, etc., etc. So in the end, this is important knowledge and experience that you can get from a bank or from a consultant firm related to risk to go after this to be CFO of a company. You know what I mean? So that's important. So, which is the difference between the balance sheet of a bank, of a commercial, or the profit and loss account of a bank and an investment bank? As you can see, in a commercial bank, other fees are not so relevant. Trading gains and losses are small, but trading gains and losses in investment bank are important. Payment services fees, payment related to credit cards, etc., are more important in commercial bank than in investment bank. Asset management fees are much more important in investment bank because, for example, JP Morgan is the most important subpart in the world. What does it mean? That they can be like a trust. If you want to purchase some shares of a company and you don't want to appear as you are the investor, you can hire Morgan Stanley, JP Morgan, Goldman Sachs, etc. to do it for you. In the end, the European directive obliges you to say which is the beneficiary, the last beneficiary of this. Okay? So you need to do. But given that you have some days to not disclose this, you can manage this. Okay? But you need to disclose this information. Okay? Okay? And then the net interest part is much larger for commercial bank than for investment bank. Okay? It's much larger. You have the net interest income. The net interest income part is much larger for commercial banks than for investment banks. You know what I mean? Huh? So with this, also if you look at the financial statements, you can see how is the impact of changes of interest rates in the BBVA group with the euro, Mexican peso, US dollar, etc. How is the sensitivity of the BBVA group to these two changes of 100 basis points of increase in credit in interest rate or a decrease of interest rates? You can start to have a look to financial statements in order to learn something from the banks. Then we are going to have a look to different banks. We can start from, if you want to Santander, okay? Then BBVA, then Deutsche Bank, and JP Morgan. Santander and BBVA are very similar in the traditional activity. Deutsche Bank makes more investment bank and more fees to IPOs, etc. And JP Morgan is the largest bank in the world in terms of market capitalization or in terms of total assets, and is the bank that is focused on investment bank. Okay? And that is different. It's the largest, it's more than 825 billions of market capitalization. Okay? So let's go. Let me to show you. You know, you are going to be able to see because here is a small. Can you see this? This is Santander. Okay, can you see this?
Yes.
It's not perfect because this board is small, smaller than the others. But what can we see here? Eh? Total interest income. This is still we don't have the last December. In the following days we are going to obtain the 25 annual financial statements. They are going to send to the Spanish SEC in just, we are, today is 15 or 15, at the end of this month. Usually they send the financial statements 2025. So we have the last 12 months from September 25, we can see that the net interest income is 46 billions, net interest income. The total non-interest income, sorry, I need to see. Total non-interest income is 17 billion, so you can see the difference relevance for a bank that is retail bank in the world. Okay, it's an international bank, but the most important source of income is net interest income. Then non-interest income has been increased in the last years, has been increased, but still is not more relevant and is not going to be more relevant. But the financial analysts price and value the way that Santander is increasing the relevance of non-interest income, because 10 years ago the non-interest income part was very, very small. So larger this part, larger the diversification of sources of income that you have. Obviously, Santander has geographical diversification because it's in America and also in Europe. Okay, that's very important subsidiary. So in the end, very important for them. Then the provisions for these last 12 months from September 25 is 12 billions. That's important, 12 billions of provisions for all the subsidiaries. These are the consolidated ones. For the group, for the whole group, not for the parent alone. For the parent alone, they separate financial statements. Okay, more things that are relevant for you. As you need, cost of equity. Capital equity estimate for every bank, the cost of equity in 12%. That is a historical average. They say, okay, which is the distance between the return on equity and cost of equity. This is the required return from shareholders. This is the real return that you are getting. So the difference is the value that you are creating for shareholders. Okay? The bank that is creating more value in Europe, I'm going to show you later on. Okay? In terms of shareholder value. Okay? Not because you are larger, you are going to create more value. No, this is not the case. You can see that they are generating 1.8 billion of value for shareholders. Okay? I'm going to show you smaller bank creating more value because they are more profitable. Okay? The return on equity is larger. Return on equity of CaixaBank, for example, 15%, 15.6. Depends on the what area you get. So perhaps when they disclose the annual financial statements, I will write something for the newspapers because always they ask me about what is my opinion. I can be wrong. I will say, but always to analyze which is the. But it's not only important. The last year is the expectations. What are your expectations for the future in terms of credit risk? That is the most important issue in banking. So another interesting thing is this one, no? Non-performing loans over total loans. We are around 3%. Given that the definition of non-performing loan has been stricter than before, if you compare non-performing loans 10 years ago, it's not time consistent because we cannot compare things that are not consistent, time consistent, okay? But you can think about 3% is a regular measure. You need to take into account that the banks sell non-performing loans to investment funds in order to reduce this, because the European Banking Authority, whose president until last December was Jose Manuel Campa, right now a professor of ESM, he comes back this year to ESM, is 3% of non-performing loans is a regular measure of non-performing loans for banks, okay? You have a lot of metrics, but I think it's much better to compare to other banks in order to little by little make a good comparison among banks. Okay. So let's go for,
Germán,
listen,
sorry. So what is like the metric where banks compete the most? Shareholders value value?
well, this is a one metric that is important. The other is the efficiency, the cost efficiency ratio. That in Spain we have a very efficiency ratio, very good is cost to income ratio, of the efficiency ratio. We are around 45% on average in the banking system, because we consolidate the banking system, we have larger banks that are more efficient. But we cannot compare the cost to income ratio to an investment bank, because the investment bank pay large salaries to employees, and the cost to income ratio is between 80 and 90%, because they are more, the focus of the investment bank is different. I will explain later on when I explain JP Morgan, okay? But this is important. This is important because it's the value that you are adding, and also the dividend yield, the dividend that you are paying to shareholders is important, okay? Because when you are a mature sector, how can you be attractive for investors? Which is your way to be attractive. You study corporate finance, right? You are working in a mature sector in comparison with a startup, they are going to sell you growth options. Like you can increase a lot, you can grow a lot, etc., and the market value can increase. They are selling this. But in a mature sector, you are not selling this. Which is the way that you are attractive for investors, paying dividends. The way to keep dividend policy that you keep maintaining in the future, and you are like a commodity, and then investors are attractive, and it's sexy for investors. You know what I mean?
Stable cash flows. Stable cash flows. That's how you
Also cash flow, but in the end, dividends are distributed through earnings. This is from commercial law, you cannot distribute through cash flows, so through earnings, but obviously, cash flows are not important in the banking industry, in fact, because they obtain liquidity they want from the European Central Bank. It's not exactly the same that the corporate. In corporate, free cash flow is the most important to value the company. And then you estimate the WACC, the weighted average cost of capital, you have the value of equity. Okay? Or you can proxy indirectly through the proxies that are used by the market. We usually use, for example, enterprise value over EBITDA, and you are in a sector of enterprise value over EBITDA of 9, so you multiply by 9 your EBITDA, and you deduct the financial debt, and you have a proxy, indirect proxy value. But then you need to value the company through these cash flows with the business model of the company, etc., etc. In fact, if you are a financial analyst, you need to make challenge to the company that you are valuing, because managers are going to give you business models that are optimistically biased. Always are the optimistic scenario. Then you need to make, and this is what is important, your knowledge about the macroeconomy, you need to make them challenge in order to say how is possible that the macroeconomy is getting worse and you are increasing sales. And your business is very is cyclical. It's very cyclical. How is this possible? And always one thing that is curious in the business models, and it happens a lot, is that they always grow a lot in sales, in profitability, what is very consistent. If you grow in sales, it's because your margin is going to be low. And also they are going to be able to reduce leverage. This is very difficult. How you are going to finance the higher activity in your company in order to sell more. So always you have some areas of the continent in the financial statements and the business model that you can detect inconsistencies. Yeah, and then you can discuss with the company, with the manager, with the CEO, etc. It's true that there are managers that are prudent and always meet the expectation, but it's not the usual one. It's not the usual situation. Okay? It's, they are not politicians, but they have some bias, as is they need to sell optimism to the shareholders, to the stakeholders, you know what I mean? To the society, because they are good. What does a CEO prefer? A dispersed ownership or a concentrated ownership? The shareholders. When you are going to learn how to use all this, you can go to the ownership structure of every firm, listed, not listed. So the shareholders of the firm. If you are a CEO, what do you prefer? Always a CEO prefers dispersed ownership because they are going to be less disciplined if the things are getting worse. If you have a concentrated ownership and you fail in something, it's much more probable than family. Imagine a banca belongs to Juan Carlos Cortés. If the CEO does something that is wrong, it's going to be fired. Okay? But if you have BlackRock that are passive investors, State Street, Vanguard, etc., in this case you are less disciplined because in fact the investment strategy is different. It's a strategy investment to be in different companies in the same sector. They invest in every sector, they are not interested to be your member because if they have a problem of competence, if they are in all the boards or in the same sector, because they manage all the information of the sector and all the business model of the sector, etc. But you always prefer and very well dispersed ownership. Okay, so this one is I'm going to show BBVA because you have here some data that I'm going to show you the most important one because you don't have time to do. You can see that BBVA the net interest income part is 25 billions. This net interest income part. The total non-interest income part is is this one. You can see that the net interest income part is much more important, 25 billions against 12 billions. But in the past they have less than this. Loan loss provision, total loan loss provision of this year is 5.7 billion. It's important. It's important expense in the profit and loss account for this bank. But what is interesting for also here you can see that the price to book, imagine in the crisis, the price to book is 2.1, in the crisis was 0.60, so has increased a lot because of the expectations of the banking sector. Santander is 1.3 or 1.4, but a lot of banks 5 years ago were below book value, below accounting value, because the expectations with such a negative interest rate and such a situation that the banks were not profitable, were not interesting for investors. And right now, this has changed dramatically, and you have price to books more than 2, that we had this before the financial crisis, before 2007. Imagine. It took us more than 15 years to get again price to books of some banks in Europe larger than 2.
What is price to book?
Price to book is the market value of the equity below accounting value, book of equity. So this measures the expectations. If you are paying more than the accounting value because you think that expectations are positive. So and you in the crisis there were banks with 0.20, 0.25. What does reflect? That the banks think that the investors think that the macroeconomy is going to get worse, and then it's going to increase the credit risk, and then you are going to increase the loan loss provision, and then you are going to reduce the equity, and they might penalize it before the market, the price to value. Okay? It's a ratio that is not perfect. It's another. You have a lot of ratios here. I loaded all these items, all the financial statements. You have a lot of information here. If you have any question, you can ask me. I need to select some in order to explain, not in a very detailed way because we don't have so much time.
Does the Tobin skew appear in the data too, or you just
Sorry?
the Tobin skew will appear in the data? You have to figure it.
Yeah, you have. I don't know if you have here. I think you have Tobin skew here. It's used in the about the expectations also in the sector. But it's more used the price to tangible equity. Okay, for banks. So here we can see that the return on equity of BBVA is 18.6%. That is the largest in Europe, and it's generating 3.8 billion, while Santander, that is much larger, much more double than in size than BBVA, is generating 1.8 billion, and BBVA is generating 3.8 billion euros. You know what I mean? So this difference is pretty interesting because they are more profitable, especially because of Mexico. Okay. The problem of BBVA is that I don't know what is here. That in segment analysis, they are highly exposed to emerging markets. You can see that the revenues from emerging markets, 72% of the net income comes from emerging markets, and that's really needs the takeover of Sabadell in order to dilute the exposure to emerging markets in the balance sheet, in the consolidated financial statements. And they need a bank of enough size. They cannot purchase. They purchase Ibercaja, Unicaja, etc. is not enough. They need an animal of 200 billion in assets in order to reduce the exposure to emerging countries. Because after leaving US, when they sold BBVA Compass, they need to rebalance the balance sheet because they are very profitable, but in a crisis of an emerging market, they can suffer, and they need to reduce the exposure to emerging market. Not also because of them, because also ECB is going to put some pressure on that, because ECB don't like that the European banks depends on excess on emerging countries. You know what I mean? So that's important. And the level of NPLs is close to Santander. There is no difference. see that the level of total non-performing loans over loans is 2.9%. Okay? Okay? So, JP Morgan. The level of capitalization is, as you can see here, is 800 in US dollars, 838 billions of US dollar, the largest one. We can see that the price to book is larger than for BBVA, but BBVA for being a commercial bank is good, 2.1, is almost the best in Europe in terms of price to book. But if we look at the profit and loss account, we can see that the net interest income part is 95 billions, while 5 years ago it was 54. This is because they purchased the Republic Bank, First Republic Bank. Do you remember in May 2023 that they purchased? And this is a traditional bank, and they purchased it because of the bank was in a very bad situation, and then they had the government to purchase in this bank, First Republic Bank, I don't know if you remember. And then this is the change in net interest income. But non-interest income, as you can see, is very important here, is almost previous to the purchase of First Republic Bank, non-interest income was larger than net interest income, okay? And almost is the same, okay? Similar, because it's an investment bank. Which is the NPLs ratio of JP Morgan?